So you might be wondering, how do we determine whether we try and do SBA financing or conventional financing? First of all, we don't have any preference whether it's SBA, whether it's 504, 7A, or conventional. From an origination point of view or fee point of view, we don't earn any more one way or the other. Basically, a couple of factors that we look at to determine whether we think SBA or 504, whether that's a 7A or 504, or conventional is the best way to go. First of all, if you are looking for the highest advance and minimal outlay for, say, a purchase or construction, it's going to be SBA, period. No debate. Right now, the maximum advance on conventional, and that's no goodwill involved, is usually in 70 to 75% range. Are there banks that will go like that on an isolated base higher? Yeah, there are some. But in general, you're not seeing more than 70 to 75%, and that is real estate equipment only. Whereas SBA, you might be able to go 80, 85, sometimes 90% financing. So in that regard, there is no question that the advance is higher with the SBA, and if someone is looking for minimal or the least amount of outlay, then we will go SBA. The second criteria that we go by is if we're going to pursue SBA or conventional financing, it's simply the cash flow of the site. If this is a purchase, and if the cash flow is a little light, because the SBA typically will have longer amortization period, 25 years as to usually 20, maybe even less on a conventional loan. It's simply just easier to qualify from a cash flow point of view for an SBA loan than it is conventional. If you're only thinking rate and term, and that's all you're concerned about, then it's going to be conventional. But if you're looking at return on your investment and cost of your funds, the SBA is going to be more advantageous. And the other thing to point out is if you're doing a 7A, an SBA 7A loan, you frequently can finance the working capital and inventory and closing costs into that. Normally on a conventional you cannot. And then on 504, 504 offers the fixed rate element on it with very attractive rates, and you can finance a lot of the soft costs on that one. So again, we don't have a preference. It's just basically based on what the customer is looking to do, how much they're looking to outlay, and then the cash flow of the existing site.